Given the current climate, should investors be looking for high dividend yield stocks? That's the question at the moment. Marcus Bogdan from Blackmore Capital joins our discussion now from our Melbourne studio. And great to have you on, Marcus. This is the key at the moment, isn't it? Where to put your cash to get yield and income plays. Particularly, it's got to be said, Marcus, in an election year when we've got some very big changes in policy for investments, potentially if a Labor government gets in.
Sure. Good morning. The dividend yield on the Australian market is one of the most attractive globally at over 4%. So there's definitely keen interest on Australians with high dividend yielding shares. We do have high payout ratios, and we're seeing that with potentially changes of government and changes of policy, capital returns have been in favour, and that was the highlight of the first half reporting season, where we had the best lift in dividends for over 20 years.
With the potential changes, just tying it in with the budget there, and if Labor were to get in, we continue to talk about the potential changes in negative gearing, capital gains tax, and obviously franking credits and so forth. Would you start to consider other high-yielding stocks outside of the banks, those traditional high-yielding plays like the banks, like a Telstra or an infrastructure stocks that you talk about? I mean, would you look at other areas perhaps to get that yield?
Sure, no, that's a good question because bond-like equities have done very well. So property trusts, infrastructure, with this sense that interest rates could go lower, have really buoyed those shares. We think that's overdone now. We would be more skewing to companies where there's still earnings per share growth, and so the earnings per share growth allows for dividend growth. So looking at the really good industrial companies, looking at areas in healthcare where you're seeing earnings grow, and also in the resources, those large resources, BHP and Rio. Higher commodity prices, strong balance sheets is allowing those companies to pay very attractive dividend yields, especially compared to something like the banks where the dividend yield is high, but there's really very little in terms of earnings growth, and I would say that would be the same thing with Telstra. So favouring industrial, healthcare and resources over sort of those bond-like equities and banks at this point in time.
Mike McCarthy, what's your view on this in general with the changes of potential policy if Labor gets in with franking credits and property and capital gains tax? What's your take on what that does to yield plays on the market? There is some talk. We had David Ellis on from Morningstar yesterday about talking about rotation into some of the other stocks like Clydesdale that have 0% franking and other ones like that. Do you see a shift or even to other asset classes?
Well, quite possibly. I mean, as Marcus has pointed out, there's been a big shift towards property trusts. They don't pay any tax, and so there's no franking attached to the dividends. So or distributions, as they're called in this case, because they're unit trusts. But the reality is, the banks, for example, are still in cash terms paying a 5% yield in a 1.5% interest rate environment. Even if you don't get the franking, that's still going to be a pretty competitive investment choice when it comes to income. So I'd be concerned about, jumping out of here, and only to realise that even with the policy change, a lot of these dividend yields remain attractive. I think Marcus makes a very good point about earnings growth. It's one of the keys, not just to sustaining dividends, but to share price growth overall. And so that focus I would certainly echo.
Look, just back to you, Marcus, there's obviously a focus around high dividend plays and the changes in franking credits from the federal budget. But we also heard news around increased funding for healthcare. So just playing a different thematic, I guess, in terms of some of the fiscal measures that have been put forward. How do you think investors could participate in this thematic with this increase in healthcare funding?
And that's very clear, and it's bipartisan support by both parties currently. And so we're looking at the primary healthcare sector, GPs, imaging. Both have been called out by both parties in terms of further support, and so you can play that through Helios and Sonic. And private hospitals, we still think this thematic around demographics, an ageing population, the baby boomers now starting to move into retirement, is still an attractive place, even though there are pressures on pricing, and you're seeing that in private health insurance. So we still like companies like Ramsay at this point in time Australia's largest private hospital operator, and also have got a strategically important footprint overseas as well to play that thematically globally.
How do you think, I mean, how are you viewing valuation at the moment in some of these healthcare plays? Because obviously, you know, I mean, Ramsay's one, but you've got other ones like CSL, which have obviously run up quite hard. They get a lot of airtime for that. Does valuation play a big role in what you're investing in at the moment? Because it is hard to find value on the market.
I think you're absolutely right, and valuation is always a consideration. The underlying momentum of the businesses is also incredibly important. So for CSL, the momentum is still very strong for that company, despite its very high PER multiple. But where it's positioned, the way that it's invested, I can still see that there's growth there of at least 10% earnings per share growth over the forecast period. So we hold CSL in the portfolio. Ramsay's earnings per share has come down quite dramatically from 3 years ago, but now it's rebasing, and the price earnings ratio has come back from sort of mid-20s to 20 times, and we think that that's a business that can grow between 7 and 8% on an ongoing basis. And then Helios, which has been unloved for quite proper reasons in terms of poor historical performance, but with new management, a focus on governments providing extra capital into primary care, we think that valuation currently still remains attractive.
All right, excellent. Marcus Bogdan, always a pleasure. We appreciate your time and analysis with us this morning. Thank you.